Welcome to episode 2 of the In the Moment podcast. Today we are joined by Gerard, who has a decade of experience in the property industry and is an incredible resource in terms of finding great property investment deals and making a return. Then we're also joined by Maurice Crespi from Schindlers attorneys, and they are our official legal partners in everything that we do here, making sure that we are compliant with legal and regulatory frameworks and that we bring you trusted and audited assets. Today we're going to be talking about property on the blockchain. What are its benefits? What are its uses? What should you be worried about? What should you be excited about? And so much more. I'm really excited to talk to these guys. So welcome to the second episode and let's get started. So I'm going to start off by asking you, Gerard, you've been in the property game for quite some time, right?
Yep, we've been involved in property, particularly residential property, since 2007.
Okay.
Yeah, we were fortunate to get into the market and understand the market for the first crash.
Yeah.
So it wasn't a really interesting baptism of fire, but we found value and have grown substantially since then.
Yeah, and so tell me, why is it so important for people to invest in property?
Well, property can be viewed in a variety of ways and offers investors and shareholders and the man in the street, I think, more opportunities than really meets the eye. You know, one is the most empowering asset a family can own, you know, and it lasts and it's generational. You know, from an investment point of view, there are good returns to be made. But I think from a risk point of view, property is one of those assets which endure over time and will always improve in value. And
a safe long-term return on investment.
It gives you really significant options down the line. You know, if you have your primary residence and an investment property or two, your children get the real benefits of those assets. And also, from just a prudency point of view, it's the safest investment. It's enduring. And it's more for savings account with a great return.
Yeah.
You know, in times of downturn, you can access the value within that property, and in times of growth, when your kids are ready to start their careers or their lives, they have either a house to stay in or an asset they can utilize to start a business.
Yeah.
You know, so it's really multifaceted, and it's a good place to be.
Great. And so we have Maurice here today. Welcome, Maurice.
Great,
do you want to tell us a little bit about your background and where you're from?
Yeah, been at Schindlers attorney since 97, primarily litigation, started hitting the blockchain space in 2017, and yeah, the rest is history.
Awesome. Yeah, that's great. And so from your perspective, I mean, we just said property is one of the safest long-term investments. From a legal perspective, does that hold true? What do you think about property as an investment?
Well, I'm a big property investor, so I concur.
Concur. Great. So, I mean, look, guys, we're all working here together to do something. What is it that we're trying to do as a team? What are we trying to make available? What are we bringing to market?
Well, from my perspective, there are two distinct property-related blockchain aspects that one needs to consider.
Mm-hmm.
The first is the creation of addresses, okay, through organizations like UNL.global. They've created a digital twin of the entire planet in 3D, so you also get height, and that can be tokenized. So what we're doing there is you take, as an example, our client, the King of the Ndebele Nation. He has millions of hectares in these trusts, a legacy of apartheid. And we can now take that property and, in essence, what I call create a layer 2 deeds office where we create NFTs that the trustees of the trust grant rights in terms of those NFTs. And voila, you have, in essence, a title deed that can be securitized. So we're actually speaking to the banks now in relation to what they require to securitize off the back of those NFTs.
Yeah.
So that's one very, very exciting aspect because it actually addresses a legacy of the past, okay, being land reform. And the second exciting space is really the tokenization, creating liquidity in the property space. And that involves, in essence, you can either go by way of an STO or you can look at other rights that can be traded as NFTs, as tokens. So what we're doing there is we're taking, from a legal perspective, legacy statutes, the law, and we're trying to plug that into the blockchain space, the blockchain world.
Yeah.
And that means looking at the Companies Act, the Collective Investment Schemes Act, the Financial Markets Act, and there's a lot more. But we're achieving it, which is very, very exciting.
Yeah, so I mean, from our perspective as Moment, from a technical standpoint, I mean, we write smart contracts, but an NFT is essentially a digital certificate of authenticity and ownership, exactly like a title deed is, right? So is there any blocker that you see for replacing a title deed, which is just a sheet of paper held in a registry, with a NFT or with a token, which is, again, just a certificate of ownership kept on a registry, except it's the most secure registry that the human race has ever invented? Are there barriers there?
I think the biggest barrier, with utmost respect to the legal profession, they're going to be fighting tooth and nail to keep those conveyancing fees in check.
So it's basically to make money.
Absolutely. I think one of the greatest advantages of blockchain will be the day where we can transfer properties at absolutely no cost. I mean, I feel that
wow, that would be incredible.
Yeah, it's unconscionable at the moment that, in fact, the tech is there for these transfers, but it's not taking place.
Yeah.
And what's more reliable than the deeds office? Blockchain.
Yeah, exactly. Yeah. Well said. So, Gerard, we found a stat actually that said that research conducted by MIT showed that 89% of investors are interested in real estate, but only 3% can actually afford to invest. And this is largely because 93% of real estate is out of reach for retail investors. So, I mean, you've been in the property game for a long time. I guess both of you have been. But from your perspective, does this hold true? What does a typical property buyer look like to you?
Well, that's absolutely correct. I think in the South African context, it's probably worse, where the demand is far higher, but the access to get into the real estate space is a lot more prohibitive. You know, we suffer from a high interest rate environment, we suffer from a high unemployment rate, and the access to liquidity is a problem. Also, people have adverse credit history. And these are all massive stumbling blocks to entering into property. Also with price inflation, you know, the entry-level properties are already out of reach for most of those people which are wishing to enter into property, be it first-time, second-time employment, or even first-time or second-time upgraders or downgraders for a variety of reasons. What tokenization or fractionalization of property means is that you can enter into space for as little as 10,000 Rand.
Yeah.
You know, and grow with your asset.
10,000 Rand versus R1 million for a small apartment, you know.
Exactly right, you know, and you can invest as much or as little as you wish. You can increase or decrease your investment, giving you access to either grow it or take your reward or your upside off the table, so to speak. But further than that is, you know, in the traditional property space, if you buy an asset for R1.5 million, for example, you're governed by that building, that block of flat, those body corporate financials, the growth of that specific block, and its tendencies and how that block performs. In this space, you're able to own assets or shares of assets in a variety of blocks, okay? And you get to choose which block you wish to invest in. And that also spreads your risk, you know. You know, with regards to the costs coming into market, there are a huge amount of costs: attorney's fees, bond registration fees. When you're selling, there's the same on the way out.
Wait, so it's still going to be just as expensive for me?
No, it's not. It's actually going to be cheaper.
Okay.
You know, not only is it going to be cheap, it's going to be more efficient. You're able to transact within moments or within minutes.
Yeah.
You know, that's just the advantage basically to the consumer or the first-time investor. You know, there are also massive advantages to people that have assets which they're sitting on that want to do either improvements, where we can take that to market, or those people that are sitting on approved plans and don't have the wherewithal or the liquidity to go ahead and take advantage of that value.
So make it simple for me. I'm a 20-something-year-old. And I've saved up 10,000 Rand. Now I've got 10,000 Rand. I want to make a really good decision on what I'm going to do with this for my future. Not for when I'm 27, 28, or even 30. I want this money to serve me when I'm 50 years old. So you're telling me now I can invest in property for this 10,000 Rand. What does that look like in a really high level? Like, make it simple for me.
Well, simplistically speaking is that you'll be able to go onto the website, you'll be able to take a look at certain properties which might appeal to you. On that website, you have the full property listing, its details, it's touch and feel through a walkthrough.
A real property, right? We're not talking about metaverse.
You know, for me, I'm not a sophisticated investor as far as tech goes. You know, the Bitcoin train I never got involved with. It's something that I don't understand. But what I do understand is the value of property and the impact that it may or may not have on my life. And you know, my assumption is, or my understanding and my business is to invest in property because I see value. Yeah. And in this instance, you have an absolutely underlying asset, which is a building with tenants. It's well managed, it's well run, it's in a decent area, and it represents good growth, you know. And you're investing in a physical, hard asset, you know, which other people see value in too. You know, and when you have a digitized or title deed or title to that building, it's the same as having ownership. Yeah. You know, that you can go in and go out as you wish and as you please, and you're always safe and secure in the knowledge that the value of your asset is always linked to the value of your token is always linked to the value of your asset.
To the real thing. So
to the real item with real income, real people staying in there. It's a building, it's got rates, water, electricity. Yeah. It functions like any other property investment, okay? Just with this opportunity and the way it's structured being fractional by nature, okay? Your cost of entry and your ease of entry is so much more simple.
Is much lower, yeah, great. So I mean, we touched on something there with this NFT being linked to a real physical thing. So Maurice, if I could ask you about, I mean, people currently understand NFTs as artwork, right? They think an NFT means an artwork. And we've collaborated before in selling Nelson Mandela's official warrant of arrest and attaching real legal rights there and IP assignments. So talk to me a little bit about what the current situation is with NFTs in terms of what their current utility and what they're useful for now, and where you think this is going to move to and how we're doing that with legal frameworks.
Yeah, so what doesn't excite me is the NFT art space and what we've seen thus far. What does excite me is the ability to actually use NFTs as legal instruments. We've created those. We've created a nastier NFT asset sales transaction instrument, a PAN, a perpetual assignment of rights NFTs, and many, many more. And really what we're doing, I mean, I had a look at the Negotiable Instruments Act, which was promulgated in the 60s, and we can actually create an NFT promissory note that complies with the Act. Now, when last have you heard of a promissory note? We're going to bring it back. Okay, so what really excites me is the fact that we can now start employing the blockchain NFT space for the purpose of actually these legal instruments, which will be immutable, and the smart contracts will execute for hundreds of years. So, I mean, this is the way to go. And I often say the blockchain is the attorney killer. It's certainly in the conveyancing space.
Blockchain is the attorney killer. I like that. That's going to be a thumbnail on one of the videos. So yeah, I mean, from my perspective, being in the space for a while now, NFTs have traditionally had no utility. They've just been a token representing artwork. They've been speculative in value, so they only trade for what people are willing to buy them for. They've been completely unregulated. There's been a lack of trust. We've seen a lot of NFT projects to raise money to do an action, and then they just disappear, and that's typically called a rug pull. There's also a lot of lack of knowledge in this space. So I think what we're trying to do here is the direct opposite of what the current state has been, and we're trying to tie NFTs to real assets that are not speculative in value. They're empirical in value, and it can be measured, and making sure that we have current legal frameworks that support this, so they can't be a rug pull, and so that legislature supports the actions here. And all of that comes around full circle into making property accessible to a retail investor. Like, to me, I think that's what gets me really excited. I love the technical components, but for a retail investor, it's less important what the mechanisms of action are behind. And the reality is that now you can invest in a really stable return asset very easily at a fractional value, and I think that's incredible. But maybe just to move on from that, let's dive in a little bit to the technical components or how we do this. So, Maurice, can you give us a high-level description of what tokenizing a property is?
Yeah, no, sure. So the token is just a digital representation of an agreement.
Okay.
And that agreement can be anything with reference to legacy agreements. So if you think of a lease agreement, you can now tokenize that. An assignment agreement, you can tokenize that. So what we're doing is we are taking rights, existing rights, either from a property owner, a trust, and we are using NFTs and we're embedding those legacy legal agreements in the NFTs, but creating them with bearer status. So in other words, whoever the bearer is of the NFT enjoys the rights in terms of that NFT. And that involves us looking at direct shareholding, STO, through via NFTs. There would be certain requirements in terms of the Companies Act that you'd have to comply with, but you can do that. Or we can create the equivalent to a REIT, a real estate investment trust, but in the NFT space. It's not regulated because none of our legislation actually talks to blockchain NFTs.
Yeah.
And that's where the complexities really arise. We're also now looking at the co-op model to actually create NFTs in that space, which again is interesting because that's pretty unregulated. The Companies Act doesn't apply, the Cooperatives Act applies, but importantly, the Financial Markets Act doesn't apply when it comes to co-ops. So yeah, that's a very, very high level.
Okay, cool. And so, I mean, maybe you could just tell me, Gerard, why should we create property NFTs? What problems are we solving here by creating property NFTs?
That's a good question. The first scenario is, or the first problem we're solving is actually giving entry-level people that have very limited savings and very limited budget the opportunity to get into the property space early. You know, if the world is changing and we don't change, we're going to be left behind. So we've got to create these opportunities and these openings, especially for the youth of this country, and the novice investor, to feel that they've made a safe entry into two spaces. One is property by fractional ownership that gives them a yield and a rental return on a monthly basis, which is better than we get anywhere else in any formalized banking environment, and then also access to coming in step with where technology is going from a banking and a financial instrument point of view. These are real environments, you know, and if we get in early and they get in early, we've just got that much greater opportunity to succeed, you know. It's where the market's going, it's where the world's going, and as South Africa, we need to step in and get involved, you know.
Essentially, it makes it faster, cheaper, safer, right? Why wouldn't we adopt the technology? Faster, cheaper,
Exactly.
safer, that's all I need
you
to
know,
hear.
the traditional mechanism, putting an offer in, you're putting an offer in at what we call full sticker price. Then you've got to wait 2 to 3 months for the property to register. On the way out, it's the same environment and it's a very expensive process. You know, in this space and the way it's structured is that.
So hold on, you say it's quite expensive. What are the kind of costs I'm looking at if I'm buying a property in the traditional sense? I'm not buying a token like we're offering here. What are the costs that I'm looking at?
Well, there's various forms of cost push inflation. One is that you're actually paying for advertising or someone's advertising and there's a sales agent involved. Okay. And
so there's agent fees?
There's agent fees. There are COCs, water, beetle, electrical compliance certificates. There's transfer duties. There's attorney's fees. There's the time value of money that you've lost being in the transition between your sale and your recovery of your funds. And especially when you need access to that liquidity, okay, and you're in a pressurized environment, you might need to sell quicker. At a lower price. So for as much as 5 minutes of your time, okay, you could be in a transaction and out of a transaction, so to speak, and transfer title on the way in and on the way out. So the benefits from a time point of view, from a cost point of view, from a fractional point of view are revolutionary in the space. You know, it presents significant opportunities right away through the value proposition stage.
Yeah. I think that summarizes it quite well. So, Maurice, why should we use the blockchain and not the deeds office?
Well, I mentioned to you that it's an attorney killer. Okay,
Yeah.
now just imagine a scenario, and if you understand smart contracts, you'd understand why. But a scenario where you can transfer a property on your phone, untransfer the smart contract, pays SARS, it pays the agent if an agent's involved, and it's instant, and no attorneys are involved. Okay, now think of what attorneys charge. Call it 50,000 rands, let's say, per transfer. That'll go, and I think that'll have one hell of an impact on the property sector. It'll actually make properties far more accessible. So in my mind, it's the only way to go. And the sooner people realize that, like SARS, that this is actually something they want and they should be pushing for, you know, so they can collect in terms of smart contracts, the better.
Yeah.
Really, the regulators need to see the benefits of this, the employment of smart contracts in things like tax collection. But I also use the example of lease agreements. When the Internet of Things comes about and it's going to require a smart contract to open a door, we're going to have a scenario where if you don't pay the rental, the door will not open.
Yeah.
And that brings in a whole host of questions. Does that amount to an eviction or spoliation? What is that? So. And there again, it's an example of it being an attorney killer because you don't need a lease agreement in those circumstances.
You just need a set of rules defined in a smart contract.
Yeah, I mean, we drafting smart contracts of just several dozen lines of code as opposed to a 50-page agreement.
Yeah.
And we can also now create agreements in terms of smart contracts which would be impossible in the legal space.
Yeah.
Take the commission on the art. Okay, can you imagine entering into a legacy written agreement that says in 100 years' time, whoever buys the art has to pay the original owner?
Yeah.
It would never happen. But a smart contract makes sure that happens.
Yeah.
And as I say, that's why I truly believe this is an attorney killer, which is for the greater good.
Yeah, and I think from my perspective, it also reduces the workload on the government or on the title deeds office
Absolutely.
as well. Adam shared with me a story. He needed to get the title deed for his house the other day, and he had to actually pay 100 rand just to see his own title deed, which he owns, and he had to go into Home Affairs. We've all seen the lines outside of Home Affairs, right? You're going to be standing there the entire day. You've got to book off an entire day to have it. So not only is this loss of productivity for the whole economy, because any individual who has to do this has to take a day off of work to go and do this, but also now you have clerks and individuals working in the government office who have to go through and look for filings and paperwork, and you could just do this on your phone.
And then,
check.
For free.
And
then you have a lockdown, and what happens? The whole market stops because the deeds office closes.
Yeah.
And you have months with no transfers.
Yeah,
I mean,
I bought my house during the lockdown,
go.
and the typical timeline is 3 months, which first of all is already too long. It took me 6 months because it was during a lockdown. Like, how ridiculous is this?
No, it's
how
crazy.
quickly can we do it on chain?
No, instantly.
Yeah.
Literally instantly.
Yeah.
I mean, imagine the days when we'd bump phones and that's the transfer.
Look, I mean, when you talk about what can go wrong in a deeds office or the process between even just a bond approval and the outgoing registration or transfer, there are so many factors that you have to combine together in a perfect sequence of timing. And if one of them fall over while you're in that deeds office for whatever reason, there could be load shedding, there could be someone's off for a couple of days, then it's on their desk. And one of that documentation, for example, a body corporate clearance certificate is out of date, that transfer gets kicked out. Okay, and God forbid your rates clearance expires in the interim, your SARS transfer due receipt expires. There are just so many variables operating in an environment full of paper, okay, which are totally out of control of the property owner, either the buyer or the seller, and the buyer wants beneficial occupation, the seller wants to be paid. And we've had transactions take up to 6 months, a perfected transaction to register between the date the sale agreement was signed to the date transfer took place. In the best case scenario, you're looking at 60 days.
Yeah.
That is if everything runs 100% smoothly.
Yeah.
And that's outside of a dispute.
Yes,
So,
yeah.
That's on a great wind.
Yeah, so I mean, talking about disputes and the title deeds office or whatever, one of the most common questions that I get asked when I'm speaking about this to banks, to panels, whatever, is, well, what happens if I lose my token? What happens if I lose my NFT? And I think for me, the one of the best answers to that is it's a lot more secure because it's on chain and because you're working through entities like us. I mean, Moment can help you recover your keys. But what people don't often ask is, what happens if the deeds office loses my paper? What if they lose? What happens there? Maurice, do you know? Is that something that's possible?
If the deeds office were to burn down, I've got absolutely no clue what they'd do. I mean, it is paper based. I'd assume they've got. We know they do have electronic copies, but we know it's centralized. It's not decentralized. So heaven forbid the server goes down at the deeds office, then we're really, really stuffed, and we'd have to recreate all these documents.
Yeah.
I've experienced that. You know, we've done in the last, since 2007, we've probably done over 2,500 individual transactions. Wow. It's on the way in and on the way out, and it happens. You know, that a file went missing, and it's literally 3 months. You know, you've got to apply for a new title deed. They've got to go to their records, which they have on electronic file. They've got to recreate those records, sealing wax and all. Okay, it costs money, it costs time. It will get done, but time is the killer. You know, frustration is the killer. People just want to get on with the business of getting on with it. Yeah. You know, and if you can save time, save money, reduce paperwork, and give people options, that's what you need to do.
For sure. And one other thing that I just want to clarify is that because this is on a distributed ledger technology, because this is on blockchain, you may lose access to your token, but you never lose the token itself, right? And the actual legal agreement that says you own this property will always be on the blockchain and always exist. So if you lose access, it might be a simpler process where you've got to go, well, I no longer have access to this, but I can prove that I'm the owner and there's some history here. Okay, a new token gets issued to you, and it would be a much simpler, much smoother process. It can't get lost in a fire or a server going down or get hacked. I think those are the really important components here. People are skeptical because it's new, but the reality is it's actually a lot safer, right? It's a lot better, a lot safer, and there's tons of improvements. So, I mean, now I just want to move on quickly to the kind of economic opportunity that we're looking at here. And the global real estate market is currently valued at around $228 trillion. And there are estimates that say that in 5 or 10 years' time, 10% of global GDP will be on the blockchain. And that's a huge portion of that is going to be made up of real estate. This has absolutely untapped potential. So that's like global potential. But what is the size of the opportunity in South Africa? And I'll ask you both.
Yeah. I mean, it's massive. Going back to the King of the Ndebele's, and we've spoken to many of the royals who are in the same position. There's this land in these trusts, and there's nothing that the occupiers can do. They can't sell it, they can't securitize it. There's absolutely nothing. So it's sitting there in this trusts, and you can't unlock, the capital, which is vital in a capitalist society. And we can now address that. We can literally take those trusts. And a good example, let me take, do you know Waterfall in Midrand, Johannesburg? Waterfall estate there, the properties are actually held in a trust. And each property has entered into a 99-year lease, and those properties are transferred in the deeds office. Now, what we can do right now with Moment, as we sit here today, is we can NFT those leases. They can be transferred on your cell phones. We can take any one of those properties, tokenize it into 1 billion tokens, sell each token to create liquidity over the property, and a lot more. I mean, I've discussed the vesting NFTs with you. Those vesting NFTs, we can even create a scenario where the property, and I won't go into too much detail, could actually pay for itself off the back of a vesting NFT. So, just take Waterfall. That would be what we would do today. Together with Moment, that's how we'd execute. keep the deeds office out of it. It would still have to be there, but we call it a layer 2. So we create this layer on the blockchain above the archaic deeds office that I think has been around for decades.
So we don't replace them, we just create a layer 2 deeds office. The title deed still sits there, and then we have a legal agreement that says, well, that title deed belongs to this company, but this company belongs to the token holders.
Yes.
So each of them actually owns this property without it needing to move around at the deeds office.
Correct.
Home Affairs can sit pretty and not need to shuffle through any papers.
Well, just take the trust scenario, the waterfall 99-year leases. We can embed those leases in an NFT, and they can be transferred outside of the deeds office.
Yeah.
Now, that's obviously what you'd want, because it doesn't come at a cost. At the moment, you still have to, even though there's no transfer duty on those transfers, you still have to pay the attorney's fees. And as we sit here today, with the tech legal knowledge that we have, that we've put together, we can execute on that relatively simply and quickly. And that's exactly what estates like Waterfall would want.
Yeah, and so I'm gonna circle back to you about the size of the opportunity, but while we're on this quickly, I want to ask you, Maurice. So in South Africa, we base our law, as most democracies do, off of old English law. There's like a common law that is shared. This means that a lot of these things that we're talking about in terms of ownership and legal contracts are actually enforceable in 160 jurisdictions around the world, because they share the same underlying common law. So can you talk to me a little bit about another common question we have is, okay, well, what happens if I move, or if I go to another country in the world? You know, owning a property does tend to lock you down or keep you in place. But now that you own it as a token, how does that differ? And is it still enforceable somewhere else in the world?
The property will always remain in South Africa. So if the laws in another jurisdiction somehow impact on the transfer, or let's say the underlying agreement is invalid, the transfer can always take place here.
Yeah.
Okay. There's those jurisdictional questions. Where does the transfer in fact take place? And most jurisdictions haven't resolved that. But I don't think that would pose a problem. Worst case scenario, you find the jurisdiction that works, and you execute in that jurisdiction.
Yeah.
Yeah.
Cool. So Gerard, what is the size of the opportunity in South Africa?
Well, I think the opportunity is massive. You know, it's all about, you know, unlocking value, you know, and value is in a variety of ways. It is pent up demand from the market, which is looking to enter into the property space, and you're able to cater for that. I think the benefits of a buoyant property market, okay, and I'm not talking about a property market which is unhealthy and running hot and there's massive price inflation and it's, for want of a better word, predatory. Okay, you're giving access to opportunities for people that really require it. You're also creating a huge amount of employment by being able to service those opportunities. In the business model which we occupy, which is, you could say, first-time upgrader or first-time downgrader, or people entering into the market either individually or as a married couple with that little bit more purchasing capacity. You have a good synergy and a tie-in between the value of your property, what you're paying for it, but also the amount of rent that you can expect to receive from a rental income point of view, and that keeps the model honest. You know, you should be purchasing an apartment between, say, 650,000 and 1.1 million, that you can get between 6,500 and 11,000 a month. You should be purchasing a 2-bedroom house between 1.5 million and 2 million, that you'll be getting 11 to 15,000 a month, and a bigger home between, say, 2 million and 3 million, for example, that you're getting upwards of 20,000 a month's rental. Yeah. And those are healthy dynamics and characteristics, because we invest in those spaces. We've invested in those spaces since day one, and we've moved with the times. All that's moved is the price point, but so has the income. Yeah. And along with it, the rental that we're able to ask for these properties.
So you're saying as the property increases in value, so too does the rental that you can charge. Exactly right. And just to clarify here, the first opportunity that we're bringing here in terms of this property tokenization is one in which someone's investing in a rental earning property. So yeah, maybe let's dial it back. We've spoken a lot about the legal frameworks, about tokenization and NFTs, but let's talk very specifically about this first one or two properties that we're bringing to market. Is it a commercial property? Is it a retail property? And we've said, you know, I buy one because it's a good investment, but what do I get what is this opportunity and what do I get if I buy it? Very simply.
Okay, so what you're buying into, you're buying into a wholly owned building, which the fund itself is involved in.
A retail building?
This is a mixed-use building. There are a couple of opportunities which we take into market. One is a mixed residential commercial building, which is it's in a decent area. It's in a good area. It's on the BRT, or the integrated transport system. There is good employment opportunities around it, and the area is incredibly stable.
So I'm assuming then it's got relatively high occupancy rates, right?
It's 100% occupied.
So it's getting rental every month. It's an income earning asset. It's an asset that makes money every month.
Exactly. So our buying dynamics over the last 15 years have never really changed, and the reason why they've never really changed is that we're always the people which are buying the assets and are responsible for funding those assets, for managing those assets, and generating a return for ourselves and our shareholders and our funders. Okay, so we're not purchasing anything that we haven't purchased before, and in doing so, we've always had to find the perfect value between the value of the asset that we're onboarding, what it's currently worth now, what the next 10 years ahead are looking like, what our exposure is on a monthly basis, what it costs to manage, what the income is, okay, and giving it an expansion. What I mean by an expansion is that's a form of risk aversion, so we need to be within percentage points away from what we anticipate the maximum interest rate payable is, and this you link to the cost of the purchase price plus the rental return that you're able to get for the property. And in each of the instances, our minimum take on net rental yield is 7%. And that 7% is better than you would receive in your bank. But not only is it better than what you receive in the bank, you have the underlying asset that you become an owner of. Yeah.
So I want to dive on that point for a second, because we did some research around this, and I think fellow South Africans typically have quite a pessimistic view of our country and the opportunities that are here in this country. But what we found was actually quite interesting, that the yields, or essentially the value of property in South Africa versus the rental that you make on that property, are actually much better here than what they are in the UK or the US. So in the US market, we found that it had an average yield of about 2-point-something percentage, and in the UK about 3.25 or somewhere around there. And in South Africa, or the Western Cape specifically, there's an average of 6.75% yield. And what you're describing as the first property that we're onboarding is actually you said
a 7% net yield.
7% net yield.
So you have your gross yield, which is your total rental relative to your cost, okay, and then you have your running cost, your maintenance, your provisions, etc., etc. So we like to keep our body corporate funds liquid. So we provide for repair work, maintenance, and we allow for 2 years worth of running costs on each of our assets. That helps us stomach any shrinkage in income or whatever the case may be, should that occur. But South Africa has predominantly always had a higher yield based on it in the property space, because we operate in a higher interest rate environment. So where the US and the UK
low interest
rate, you're required to return a smaller yield. Where over here, it's high interest rate, high yield, But the balance will always lie in the market segment within which you trade. At the lower end of the market, you have a different risk parameter. It goes towards the area that you're able to invest in at the lower value, and the kind of tenant that would normally occupy that place, which is high density in a lower LSM group area. And then at the higher end, you have aspirational product, which never get the rental yields that you'd look for. So we place ourselves in a very specific market segment, so we're able to generate the returns to someone that's buying to own it, like our investors, or someone that is looking for bang for buck in terms of what they're able to get over their heads and what they're paying relative to rental.
So over the last decade, you've had to choose these properties that will create a sizable or a meaningful return to your shareholders. And essentially what we're talking about now is that the shareholders will be token holders, right? And they can be anyone, rather than just a millionaire who's got extra bucks to swing around. It can be a mom and pop, it can be a 25-year-old, it can be absolutely anyone. And you're going to work really hard at making sure that you pick properties that give them a solid return. And Schindlers is going to be involved making sure that there's legal support for something like that, and Moment will be involved to make sure that it's easy to use and easy to do through an application.
You know, the thing is that and traditionally, you know, when you're building a property fund or a portfolio as an individual, it's incredibly challenging.
Yeah.
So you have this thing called the consortium, which is a number of shareholders and investors that have balance sheet that go through the bank to raise a huge amount of capital or a specified amount of capital to enter the marketplace and to transact. Yeah. In this instance, you are the consortium. Yeah. And you can put for 10,000 Rand or whatever the token value is at the time, that puts you in a consortium environment. Think of it as a co-op, which is the best way to go. Your buying power is enormous. You have choice, you have flexibility. It's incredible.
Yeah, and if you need cash, you can just sell it off on the secondary market, you know, if you're in a bind, which is a lot more liquid than what the current situation is. If you own a property, you'd have to get an agent, like you said, put it out to market, wait for buyers to come in, consider offers. You know, the whole thing will take forever.
Look, I think you know, if you look at it this way, okay, if you're in the position to get involved in the residential property space as an investor and you're following the traditional route, you have one or two investment properties. Okay, you're either in or you're out. Okay, when you sell, you're sitting on cash or you're sitting on a realized value, and then you've got to put your foot back in and go through the whole process all over again. Yeah. In this instance, okay, because you're tokenized, okay, you could have, and you've got value which has increased over time, and you say, I don't have to leave the space entirely, I can leave it partially. Okay, so I can say I invested for 200,000 Rand. My tokens are now worth 300,000 Rand. You know what? I'd like to leave the 200,000 Rand in there and take 100,000 Rand of my value and invest it elsewhere or take it out. Yeah. Because I'm tokenized.
Yeah, I think that's important. This is collateralized tokens, okay, are not volatile. I think it's important for the audience to realize that.
Yes, that is a very important point.
The evil that everybody's been complaining about when it comes to Bitcoin, Ethereum, and all of that.
It's volatility.
That's volatility because it's not underpinned by an asset. Over here, we have collateral, which really pegs the value of the token. So what I don't want is the audience thinking, no, we can't get into this because look at what's happening in the crypto market. This is very, very, very different. Don't confuse the two.
It's totally different. You know, if you look at it in commercial terms, you have a building, which is the same as the building next door. It represents value. There's a going market and a definable going market value of each property. It's available through an agency or CMA or any of your online valuation platforms, and it has value. Even the municipality and council values that building, okay? If your digital asset or your token trades at a discount to that net asset value of that building, someone's going to buy it out for the value of that unit. Yeah. You know, so I mean, as I said, I never really understood the tokenization or the Bitcoin environment. I understand bricks and mortar and property and tenants and neighbors and how to grow an asset and how to look after our buildings and make sure our tenants are happy and paying. You know, and here you have an environment which links the best of all worlds. Yeah. Okay, and as an investor, you know that if my asset, if there's a portion of the building which is trading below value,
you're going to buy it up.
I'm going to buy it up.
Yeah, because you can see that opportunity.
Exactly.
Yeah.
You know, what is the underlying asset in all your transactions? In this instance, it's property.
Yeah. So, Maurice, if I posed the question to you and I said, how do I know that this is legit? How do I know that this is not a scam?
Okay, we recognize this is an issue. About a year ago, we formed a company called NFT Auditors. You can see it at www.nftauditors.com. Published audit reports go on to www.auditednfts.com. And the idea there is we've got a panel of experts in every discipline, and we audit. And the purpose of the audit is to make sure that the NFT owner or creator, whatever he says, okay, is what it purports to be.
Yeah.
Okay, so we confirm that. We say, yes, he is the owner. These rights do attach to the NFT. This will happen. And we provide a detailed report. And I think that's vital. And then what you can do is you can always check on the website as to whether the NFT is legit or it's a copy, you know, fake.
Yeah.
And that's why we created NFT Auditors. I think it's a very, very, very important step that's required in actually creating value of these NFTs, because as you know, NFTs can be copied, but they do have unique IDs attached to them, and that's what we reference to.
Yeah. Yeah, so I mean, we've got audits here, and this is supported by current legal frameworks. If it was so legit, surely the banks would be involved, right?
Well, I think when you talk about banks, you talk about one thing predominantly, and that's gearing.
Yeah.
You know, what this does significantly, okay, because a significant portion, and in some instances it'll go over 100% or up to 100% of that asset is paid for in cash, i.e. it has no gearing. You know,
So no debt in simpler terms.
no debt. Okay, and there's no better way to de-risk a bank, okay, than to reduce the amount of debt which they hold over any asset. You know, and when you predominantly go to market, we will set thresholds for each asset, along with ourselves as the property owners or the initiator, so to speak, or the person that we might enter into a co-development relationship, which is the traditional person that holds the title as it stands right now, where we elect to say we only require X percentage of gearing from a bank, and it would be probably no more than 25%. Of the value of the asset, because at a certain threshold you're going to market anyway, and you're allowing that, and when you're deploying capital, okay, by raising and offloading, so to speak, your tokens, you're only raising the amount of capital that you really require to take the asset to market. It makes no sense in distributing on the first go around or launch of the asset more than 100%, because you don't require it. So it allows you to raise a specific amount of liquidity from the market at a much cheaper rate, and do what you need to do. If you require bank gearing, the bank's still will still have possession on the asset, but to a much better percentage and much less exposure to the bank. You know, so I think the benefits for them in terms of de-gearing assets are great. And also down the line, you know, our experience is that there are quite a few distressed assets in the marketplace where people are simply not able to offload the assets for a variety of reasons, or they're overcapitalized, to take a look at those assets and what we call rationalize them and create that liquidity around them, so the bank can really remove themselves away from risk, you know, and do what's required to take that product to market. And this is all about timing. You know, nothing scares a market and the value of an asset away more than its distressed nature. And that has effects not only on that building, on that asset class, but that overall area. You know, if you drive past a tired asset or a development which is substantial, that's just simply can't be completed because the numbers don't work anymore. Okay, this is a way of de-risking a bank, taking the asset that was initially set out to be developed and actually completing it, tenanting it, and you improve the area. You've given access to the market to participate as an owner or as an occupier, de-risk the bank and provided value to everyone.
And it also presents an interesting opportunity for the banks when it comes to repos. If they go in and they need to repossess a property, what they can now do is actually tokenize the property. As opposed to auctioning it and getting for sale values, they could tokenize it and sell off the tokens, and presumably, I'd assume, get a better value because of the market out there, the access to a greater market. So interesting.
Yeah. What's really interesting as well is we've done some work with Troy Gold, where they're tokenizing 60 million rand of gold and putting it on chain. And then what they're going to do is, so you own some gold as a token, right? If you wanted to take out a loan, you could give them this asset held in custody, essentially, and then you have a credit card and you can go and spend up to 75% of the value of that asset. And if you never pay it back, then they just have the right to claim the asset. So, I mean, right now we have a situation in which you can take a loan off of your mortgage, but in this case, we're talking about buying into a property cash up front. And so now you've got this token, but you can actually go and take a loan off the back of that token, and these rails are already being built and already being implemented in the real world. And I think that's really exciting and really cool as well.